Hello there. Welcome to The Open right here on BNN Bloomberg. Here are the big stories we're bringing you from our newsroom. Brookfield Asset Management and Singapore's wealth fund, GIC, have offered to buy Australian-listed National Storage Real Estate Investment Trust. The deal is valued at over $2.5 billion US. The Australian self-storage provider says it aims to reach a transaction by December 7th. National Storage operates more than 270 centres across Australia and New Zealand. Shares in Dell rising in the pre-market. The maker of computer equipment, including servers, has raised its annual projections for the AI server market. The company says AI momentum is accelerating in the second half of the year, leading to an unprecedented volume of orders. Bloomberg reports that filling those orders has caused Dell to incur higher costs, and the company is working to make its AI server business more profitable. Shares in Deere slipped in the pre-market. The tractor maker's profit outlook for the year fell short of expectations. Deere estimates that 2026 sales for its big agriculture segment will be down 15 to 20% in the US and Canada. This is the world's biggest farm machinery maker, and it said in August that tariffs had cost $600 million US. U.S. futures pointing up on renewed hopes of interest rate cuts south of the border. Let's have a look at how the TSX traded yesterday. We have seen this week a bunch of bank stocks hitting record highs, including National Bank and Royal Bank of Canada. Let's have a look at oil. It's been under pressure this week on the prospect of a deal to end the war in Ukraine, which could release Russian oil onto the global market. And let's check out gold. Gold usually does well when talk of interest rates is in the air, and sure enough, it's higher. And finally, let's have a look at Bitcoin, the biggest crypto. It has had a miserable few weeks with investors backing off, and you can see now below $87,000 US. We've had economic data out of the United States that points to a softening or at least slower growth, and that has raised bets on a Fed rate cut next month. Let's get the thoughts of Eric Thiel, Chief Investment Officer at Comerica Wealth Management. Eric, thanks very much indeed for joining us. First off, I mean, does it matter if there's a rate cut next month or not?
25 basis points sounds like an insignificant cut in the scheme of things, but if you look at how this market is priced, the need for additional stimulus, earnings that far exceed expectations, these are sort of the things when you have a market priced at perfection that you're going to need to keep the momentum going. So it probably doesn't have a big effect as it relates to consumer confidence, spending by the consumer, but it does pose an important ingredient for market multiples, and we need real rates to start ticking lower. So I think additional stimulus, both fiscal and monetary, is important at this point.
Do you say in the economy, one negative factor that's yet to fully play out is reduced immigration?
Immigration is, I think, the policy that's been least talked about and is likely to find itself weighing on markets in 2026. And I think the aspects are mixed in that you're seeing disinflation from immigration policy in rental markets come down. However, I think in some jobs, particularly, we've looked at construction, leisure, hospitality. Those are areas that have benefited from immigration coming in. As that's extracted out of the system, I think you'll get wage pressures in those particular areas and in states like Texas and perhaps Florida that have been big beneficiaries of immigration. all that balances out. We think it puts a little bit of upward pressure on inflation when you balance and net those out. But that is the key policy, I think, that has not been talked about enough, particularly as it trickles down into the inflation readings.
We talk about consumer spending numbers, retail sales, et cetera, as though all Americans were affected equally. But you say that we've got this bifurcated economy, the wealthy are doing better, and that may be giving us a rosy picture of consumer strength and spending?
No question. We've talked about this K-shaped economy. We have a significant wealth effect that's taken place from the higher stock market, asset values going higher. But that has not trickled down to the bottom 60% who felt the brunt of tariff and price increases. And not had the sort of wage acceleration to keep up with the inflation that started just a few years ago. So although inflation's moderated down at the 3%, far lower than we were a few years ago, those price increases were locked in. They're permanent. There hasn't been disinflation to offset those, and wages have not kept up. So the bottom 60% of income earners been negatively impacted by a lot of the policies, particularly tariffs. So we've got relief on the way from tax cuts coming in the second half. And I think some settling of the tariff price increases, but it's been a bipolar market. And I think as we look at spending for the consumer, those luxury items and high-end retail, that I think will continue to bode quite well in the market as we get further into next year.
You are suggesting that investors overweight small and even micro cap stocks. First off, give us your definition of a small cap. What I know it's hard to be categorical, but
Small caps typically can be below 3 billion in market cap. It's crept up. It used to be much lower than that just a few years ago. But there's a lot of things lining up right now, I think, for small cap, particularly when you think about interest rates that are being cut. Tends to be very stimulative for small caps, a steeper yield curve. Now, when you talk about micro cap, you're talking about typically companies that are under $1 billion in market cap. In this universe, there are lots of low quality companies. I refer to them as sort of the zombie companies walking around unprofitable, not making money. But there is quite a bit of profitable companies, at least 60% of the universe that is in good shape, I think will benefit from some adoption of AI, the steeper yield curve that I alluded to, and then continued deregulation and consolidation that takes place. So small caps are at a significant discount to large caps. They do not have nearly the concentration, not only at the stock level, but also not at the sector level in an area like technology. Much more diverse. You've got exposure to, I think, areas of the market like financials that are ripe for consolidation. They've done well of late. But I think that sort of shift is likely to take place as we get some rotation and broadening of the market as we head into next year.
You're saying underweight the Mag 7. Sorry, just to reiterate, Mag 7. You're cautious. You say valuations are not extreme. Carry on.
Valuations not extreme at this point. However, when you look at the Mag 7, with really trading at a 45% premium to the overall market multiple, the S&P in itself is expensive by historical standards. And if you look at projected returns going forward, it does not bode well for future returns. However, you have to look for opportunities where you have stock selling at discounts outside of the Mag 7. And I think those areas of the market like financials look more ripe for returns. And then you look at areas like small cap that have not participated in the rally. And that's where you can find opportunities. They're all expensive by historical standards. So I think you have to look at those forsaken sectors. And small cap would be one. More value-oriented sectors in the S&P would be another, where they're expensive, but not nearly priced to perfection that you see in technology stocks at this point.
Eric, thank you very much indeed. Have a wonderful Thanksgiving, by the way. Eric,
thank you. Likewise, you too.
Eric Teal, Chief Investment Officer at Comerica Wealth Management. Coming up, we'll tell you about a report from RE/MAX that's painting a brighter picture for the housing market. The Canadian housing market may be on the upswing. That's according to a new 2026 housing market outlook released by RE/MAX. According to that report, more buyers are preparing to enter the market, and home sales are expected to increase by about 3.5%. Let's get more from CTV's Scott Hurst. Scott.
Good morning, Andrew. If you've been sitting on the sidelines, biding your time to get into the market, really biding your time to become a homeowner, while the market conditions may be tipping in your scale next year, as this latest report from RE/MAX looking at 2026 really is a much more favorable outlook for the housing market when it comes to the entirety of next year. The housing market could be on an upswing, according to this report from RE/MAX. This is the 2026 Canadian housing market outlook, and some of the key highlights that we're able to pull from the report include sales expected to increase just shy of 3.5% next year, with prices falling about 3.7% on average, with a third of housing markets shifting into balance. And according to the survey, some 1 in 10 Canadians, some 1 in 10 respondents, about 10% plan to buy a home in the next 12 months. That's up from 7% earlier in the year. And Andrew, half of them, according to the report, will be first-time home buyers.
Just remind us, what are the factors that may be leading to renewed confidence among home buyers? I mean, I guess lower borrowing costs are a big one.
Yeah, that is definitely a big one. Of course, in 2025, this year saw a whole lot of economic upheaval right across the country. A lot of it can be tied to the ongoing trade and tariff situation with the White House, with the United States, causing a whole lot of overall economic uncertainty. So that has weighed on Canadians, as well as ongoing affordability concerns. So if we look at the conditions going ahead in 2026, these conditions really could entice more buyers. As I mentioned, prices moderating. That's due to more inventory, more balanced conditions, as RE/MAX points out. According to the report, new listings year over year increased across pretty much most regions across the country, including a widespread boost in southern Ontario. So in terms of the sales outlook, you have all that inventory pushing prices lower, coupled with falling interest rates, as you mentioned, much more favorable rates from the buyer's perspective. That is expected to bring buyers back in 2026, Andrew.
Thank you very much, Scott. Scott Hurst, our colleague at CTV News. Our next guest says that BHP dropping its bid for Anglo American brings the Anglo takeover of tech one step closer, but hurdles remain. We'll be right back. So BHP again abandoning a takeover pursuit of Anglo American, and that may open the door for Anglo American to go through with its takeover of Canada's tech resources. But there are still a few potential hurdles. We got perspective from Maximilian Hess, principal at Enmetana Advisory and fellow at the Foreign Policy Research. He began, though, by discussing copper's role in increased mining takeovers.
The copper assets are really what's at question here and what has been driving a lot of M&A activity. This comes as Anglo American itself is making a bid for Canada's tech resources, primarily interested in their joint copper tie-ups in Chile in particular. And this is really driven by geopolitical trends in much the same way, just very different ones to Russia and Ukraine, but ones coming out of the increased interest in trying to control supply chains and commodity markets, given copper's use in AI and the renewables agenda.
But you say that the Anglo-American tech deal isn't a certainty. For one thing, the Canadian federal government says it's imposing tougher terms than have so far been proposed.
Well, that's exactly it. The Anglo-American deal has faced challenges. There are questions over its plans for its future headquarters, but whether it will keep its listing in London or move that to Canada, something that the Canadian government has reportedly been pushing for. So that tie-up is by no means set to go ahead. It faces a key shareholder vote in the coming weeks, but the regulatory challenges will hang over it as well. That copper demand, though, seems to be fairly strong. We see it in a number of other metals driving similar trends, but I think that one of the challenges here is that initially BHP had made a bid that was contingent on divesting some of Anglo-American's assets, and it does face challenges in doing so, with whether it be its coal portfolio, its diamond mines in Botswana, which it's been moving to sell and have been the subject of a lot of geopolitical questions, or even its key fertilizer mine here in the UK that has faced a number of challenges.
Sorry, you're talking about BHP there.
Sorry, no, about Anglo-American.
Anglo-American, yeah, I wanted to clarify that. Yeah, so I didn't know Anglo-American involved in a fertilizer project in Britain?
Yes.
That's interesting. Yeah, I hadn't heard about that one. If the Canadian government was to veto this deal, this takeover by Anglo-American, do you think it would send an unfortunate signal to the world business community, about Canada being protectionist or arbitrary in its governance?
Well, protectionism is really gaining a lot of traction in a number of governments around the world, of course, in the United States as well. So there are key questions that Ottawa has to look at itself and decide how it wants to regulate its own mining industry going forward. Of course, Teck being one of the last very large Canadian domestic firms, but Canada playing a very large role in the global mining industry through listings there. So there's a number of geopolitical questions that certainly Canada faces, and that's why it's been subject to so much regulatory scrutiny.
It's interesting. I mean, prior to Mr. Trump's current incumbency, you'd think, and really the emergence of economic nationalism, protectionism, you might have thought, well, Canada would be wary of taking a strong stance like that. But it seems like the rules have changed now, and countries are expected to stand up for domestic industries.
Yes, I certainly think that that's something we're seeing in the mining sector as well as in the tech sector. The EU has recently been in its own fights with Chinese chip-making companies. Protectionism is a global trend at this stage.
What do you think, will this, assume the Anglo-American takeover of Teck goes ahead and they finesse something, although it's interesting, sorry, just to return to that, it sounds like Anglo-American is determined not to have its actual domicile moved to Canada. They want to stay principally listed on the London Exchange.
Yes, there are big regulatory differences and enforcement differences depending on where that listing is. My understanding is the Canadian government has pushed for that listing to be moved to Canada. That is one of the key regulatory questions that really hangs over this deal, certainly.
Yeah, they would have a listing in Toronto, but as you know, it wouldn't be the primary listing as currently proposed. Do you think we will see a rush now, a land rush, to try to acquire copper assets by other companies?
I certainly think that what the ultimate outcome of Anglo-American's future is, whether this tech tie-up goes ahead or whether it does not, will trigger further reverberations in the industry and potentially appetite for assets, yes.
And isn't it interesting, just taking a long view, for decades, it looked like countries weren't really concerned about where their metals were processed. I think the feeling was, well, intellectual property is the important thing. Who cares who smelts the metal? But it's a very different tone these days.
Certainly it is. We've seen metal tariffs be at the top of the Trump agenda. We see demand for AI data centers and the power needed for them, which is a very copper-heavy industry. That's really helped boost the price a lot in recent months. Questions about where those will be based and the geopolitical regulations that come down over them. And that's trickled down into the supply chain, whether it be at the chip level from a few years ago or now increasingly at the raw commodity level, and not just rare earth minerals, but major metals as well.
There's the possibility that a memorandum signed by Ottawa and Alberta could lead to a new pipeline. However, at this stage, BC intends to fight it. CTV's Mike LeCouture has the latest.
We fought successfully, I might add, so many pipeline battles in British Columbia.
A stern warning from the president of the Union of BC Indian Chiefs. His group is firmly behind coastal First Nations in opposing a pipeline in that region.
At the end of the day, if things go sideways, then we're out on the ground. We're, at the designated sites.
Grand Chief Stuart Phillip wouldn't say if that could include rail and road blockades like those that sprung up in 2020 in support of the Wet'suwet'en hereditary chiefs who were protesting another energy project.
The Honourable Leader of the Opposition.
Conservative leader Pierre Poilievre wants to know when the signing of a memorandum of understanding with Alberta will lead to shovels in the ground.
On what date will construction begin on a pipeline from Alberta to the Pacific?
Prime Minister Mark Carney said that's not the point of the agreement.
The memorandum of understanding that we're negotiating with Alberta creates necessary conditions, but not sufficient conditions, because we believe in cooperative federalism. We believe the government of British Columbia has to agree. We believe that First Nations right holders in this country have to agree and support.
But does that mean First Nations will have a veto over the pipeline? Not according to the former Minister of Natural Resources and current BC Liberal MP.
Well, I think the Supreme Court was pretty clear on Trans Mountain that there's no effective veto on the part of any particular First Nation.
Same goes for the provinces, even as Prime Minister Carney promises collaboration with BC. Minister of Natural Resources Tim Hodgson says that the ultimate jurisdiction for interprovincial pipelines rests with the federal government.
Let's take a look at U.S. equity futures as we count down to the opening bells. It looks like we are going to get a positive open this morning on hopes, as I mentioned earlier, of more interest rate cuts. Oracle is one stock. Maybe we can put up a one-year chart for Oracle. It was up in the pre-market. It has suffered, though, over the past few months on concerns over its massive debt load to invest heavily in AI equipment. However, Deutsche Bank says the current price implies little credit. Investors are assigning little value to its business with OpenAI. Oracle shares, though, as of today, down 40% since they hit a record in September. And maybe we could just put up a 5-year chart for Royal Bank, the flagship of the Canadian banks. The Canadian banking stock index has been hit a record high yesterday, and Royal Bank trading in record territory. But the Canadian bank stock index in the past year for investors, total return including dividends, 35%, and just without dividends, as you can see, about 30%. Up next, we got those opening bells. Okay, trading's underway. There are those bells at the NASDAQ. I think it's Almonte is doing the honors. At the NYSE, it was going to be Macy's. And in Toronto, it's a company called VVT Medical. They specialize in minimally invasive treatments for varicose veins. It is time for the first 50. Let's check in on the equity markets because, sure enough, stocks pointing upwards after that rough week last week. And there was a bit of choppy trading yesterday. Remember, NVIDIA, as of yesterday, was down about 17%, almost 20% from its record high. Let's check out how some stocks are moving in early trading. The lumber stocks got a boost yesterday on hopes that the Canadian government will come through with help for the industry. Brian Platt of Bloomberg reporting that this country, the federal government, will tighten the rules on steel imports again and offer more financial help for lumber producers. Both of those industries beset by U.S. President Donald Trump's tariffs. And let's have a quick look at Algoma Steel, pretty well our only publicly traded steel name right now. It's flat, and of course that stock has suffered with the essential loss of its U.S. market over the past year. Let's get more on some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Thanks very much indeed for joining us, Jeff. Workday down. Analysts mixed on results from this company?
That's right. This is so far the worst performing stock in the S&P 500 this morning. Largely what happened, the results, as you said, were mixed. Not that bad, not that good, but Wall Street was looking for a little bit more margin improvement from Workday. So there was Citi came out this morning with a note that said it sees more limited margin upside for the company going forward. The forward guidance on those margins were a negative, according to RBC. Although there were some other bright spots within the report, including the subscription revenue guidance for next year. However, the guidance for the margins were exactly what Wall Street thought they would be. If you look at Bloomberg estimates, which apparently is a little bit below what they wanted. They wanted to see more growth, according to many of the research notes that are out so far on Workday.
Okay, and we talked about this earlier. Deere stock came under pressure in the pre-market. Investors in this name looking for a rebound in farmer spending, but apparently that's been elusive.
It apparently is elusive, and it looks like it might continue to elude them. Deere was out this morning, and they said that they see a potential recovery or a trough, the low point coming in 2026. So that's pretty cold comfort for investors this morning that are watching this stock fall. This is the second worst performing stock in the S&P 500. Bloomberg Intelligence had a note out this morning which called this underwhelming, and it shows a more severe and more prolonged agricultural downturn than had previously been expected. Now, if you look at the revenue guidance, or pardon me, the net income guidance from Deere for next year, they're seeing between $4 and $4.75 billion in net income. That's what they see happening. Wall Street had expected 5.31, so that is a big miss. That is a big gap between where Deere sees its net income next year and what Wall Street had hoped for. And as a result, this stock is getting punished today.
And finally, Autodesk is up. It boosted its profit forecast.
Yeah, they're seeing a little, a really nice bump so far this morning. Deutsche Bank was out this morning upgrading the stock as a result, called it the cleanest quarter they'd seen from Autodesk in years. Autodesk is a company that makes software for architecture and design solutions, as well as, I guess, a few other applications. But it was that profit forecast that is really getting some attention. This is the top performing stock in the S&P 500 this morning. So it's not all doom and gloom in terms of quarterly results. There are some stocks that are getting a lift. This is the top performer so far.
Thanks very much, Jeff. That's Bloomberg's Jeff Morgan. Coming up, we're going to get more on this new frontrunner in the race to replace Fed Chair Jerome Powell. More investors are betting that the Fed will, in fact, cut interest rates again next month. Bloomberg said that Kevin Hassett, a Trump ally, has become the front runner in the race to replace Jerome Powell at the Fed. And of course, that is seen as, if he takes over the job, it's seen as inclining the Fed to reduce borrowing costs still more. Let's get more from Carl Shimata, Chief Market Strategist at Corpay. Carl, thanks very much. Always great to talk to you. Getting inside the councils, the labyrinth of the White House, very difficult. But if Kevin Hassett were to become Fed chief, would he be enough to sway the central bank to cut interest rates faster?
I don't necessarily think so. That's kind of the funny part. Right now, markets are clearly anticipating a more dovish, policy response from the Fed going forward. There's definitely the idea that Hassett will steer the committee toward delivering more rate cuts on a shorter timetable. But the reality here is that the Fed is a consensus-driven institution. It does require a majority of the committee to, approve a rate decision. And if anything, the White House appointing someone who's very clearly partisan and very clearly, sort of being put into the role on the basis of his loyalty to the president, that actually might mean that other committee members are a little bit more reticent to sort of, go with the flow. I think to some extent we might see, the economy really driving those decisions as opposed to the dovish impulses of Hassett himself next year.
And what is your take, Carl? Is the U.S. economy weakening decisively, or is it hanging in?
It's not decisive at this point. Clearly we're seeing a rolling over in consumer sentiment and indicators like that. On a soft basis, a lot of the indicators that you look at are telling us that consumers want to be more cautious, and that investors and businesses are also, sort of moving to the sidelines to some extent. But when we look at the hard data, virtually nothing is showing, a hard, decisive pivot in the economy. Reality is that consumers are still out there spending. If we look at higher frequency data releases, they're pointing to a year-over-year increase in retail spending, for example. Businesses are still investing. We're not seeing that sort of, that decisive or clear-cut evidence of the economy running into a wall. That being said, when we think about how the Fed is setting policy right now, they are thinking about this from a risk management standpoint. If you look at what a lot of the policymakers have been saying recently, they've been saying that if we see, labor market conditions soften a little bit, that could raise the risk of a non-linear downturn in labor markets and then across the rest of the economy. So they're inclined to deliver what they might characterize as a risk management cut, as opposed to, this sort of aggressive easing campaign. And so, I think that the evidence is not there yet. But when we think about how the Fed is going to approach this, they're probably going to err on the side of caution. They're probably going to want to ease policy a little further, and then wait for next year when the real effects of this year's policy turmoil begin to show up.
Give us your thoughts on the British budget. Rachel Reeves, the Chancellor of the Exchequer, talking about £26 billion of tax increases. But there was chaos. A bunch of data got released early, and she's not happy about that.
No, I really can't blame her. It was chaos on trading desks around the world as well. The funny part was when the document was released by the Office for Budget Responsibility, I didn't know if it was real. I wasn't totally sure if it was a misprint, a reprint of something that had come out before. There was a lot of skepticism initially, and then it became clear that it really was an accidental release of what she was about to say. And it did cause a little bit of havoc, but when we look at what was laid out in the budget, it sort of aligns with what markets had anticipated. It does, point to a degree of fiscal discipline. The government is looking to avoid sort of an increase in indebtedness over time, an increase in borrowing. They are not pushing the limits as, the Liz Truss administration did a few years ago. That has meant that, the gilt market, that the pound itself have not moved all that dramatically. However, there is a bit of skepticism embedded in all of this, because if you look at how the budget is sort of temporally set up, we have a lot of spending coming through in the short run, and the tax increases kind of kicking in over a prolonged period of time. So it's like a front-loaded budget, right? We're familiar with these, of course, being here in Canada, but the reality is that markets, when they really look at this, are going to really say, well, how many of these projections are really going to be borne out in reality? What path is the UK on? And unfortunately, I think that at the end of the day, the UK's vulnerabilities are still going to remain on display.
In particular, their uncertain future in trade after they quit the European Union?
Yes, Brexit has certainly inflicted damage on the UK economy. There's no doubt that in the years since the referendum that the pound has traded lower, that trade relations have not remained on an even keel as much as they did before. But the bigger story, I think, is just a very simple one, and it's that the UK is running a twin deficit, right? They're running a very big fiscal deficit, as well as running a trade deficit. And so what this means is that on an ongoing basis, they need to attract foreign capital. They need to attract capital from the rest of the world, or get UK entities to give up some of their foreign holdings and bring them home. And so what this means is that you have sort of an ongoing vulnerability whenever there's a shock or a loss of confidence in the UK economy or in the government's fiscal stance. Then we tend to see a lot of downward pressure placed on the pound. And so what this has meant is that the pound has consistently traded in a more volatile range than its counterpart across the channel. And that doesn't seem likely to lift anytime soon.
Our own Prime Minister, when he was head of the Bank of England, was outspoken in warning of the dire consequences of Brexit. He has his critics in Britain, people who are fans of leaving the EU. But have his concerns been borne out? I guess this is a thing that will play out over decades. Was it a bad move for Britain to leave the EU?
It's hard to say in the very, very long run how this will pan out. But, if we look at the efficiency of the economy, I would certainly say that this is sort of on par with what Trump is attempting to do with the U.S., right? The day that you put a lot of sand in the gears of international trade and international capital flows is the day that you make your economy less productive in the long run. And so, we are seeing that pan out. I think most British citizens at this point are expressing what in colloquial terms a few years ago started to be called regrets. The idea that they regret voting for Brexit in the first place. But yeah, and the other thing I would kind of highlight there as well is that it was actually Mark Carney who stated the problem quite succinctly. He said that the UK is dependent on the kindness of strangers from a capital flow standpoint, right? And that's what us currency traders are watching all the time. We're watching, how attractive is the UK to international investment, and unquestionably Brexit has damaged that standing over time. Perhaps it'll pivot someday. Perhaps it'll be a really good thing to be on an island and outside of the continent. It might actually pan out in the benefit of capital flows, but for now it's definitely considered a vulnerability for the UK economy and for the pound itself.
That's interesting. I mean, because that's always been the case with Britain. I think their currency has been vulnerable to capital flows. Remember in the 70s anyway, they would have these currency crises. They'd have to get help, international help to support the pound.
Yes, actually going way back, I was thinking about the Suez crisis a while back. So back around that time, the Americans basically held the UK over a barrel and said, you need to step back from this Egypt situation, or we're going to stop funding you. So it was very much as if the UK was an emerging market. Then, of course, we had the '92 breaking of the Bank of England by George Soros and other currency speculators. All of that has induced a degree of PTSD in currency traders. I think post-traumatic stress syndrome, right? And actually, I shouldn't just say that it was the breaking of the Bank of England that reminds us of all of this. Clearly, the Liz Truss episode was an absolute shock, and has reminded everyone of the frailty of British financial markets. And so, yeah, unfortunately, all of that means that the UK has to put its fiscal house in order in a way in which other major economies have not had to in recent years.
Carl, always great hearing from you. Thank you very much.
Thank you.
Carl Shimada, Chief Market Strategist at Corpay. Yesterday on Market Call, we were joined by Andrew Moff, Senior VP and Portfolio Manager at Vision Capital. The focus, real estate, and his top ideas were Digital Core REIT, Go Residential REIT, the luxury New York apartment play, and Chartwell, retirement residences. Today on the show, it's the erudite Martin Cobb, Senior VP Equities at Lawrence Steinberg Wealth Management, and his focus, US and Canadian stocks. Up next, shares in Urban Outfitters surging after the company beat sales forecasts. We'll be right back. Shares in Urban Outfitters sharply higher today. The retailer of clothing mainly, they also sell furniture and home goods, reported strong Q3 earnings and an even stronger outlook for Q4. We are joined by BNN Bloomberg's Lindsay Biscaya. Quite a jump for that retailer.
Yeah, quite a jump, as we see almost 10% at the moment. It was up almost more than 11% before markets opened today. So we're seeing a strong Q3 earnings. Net sales beat estimates. Net income up by $116.4 million US. Record sales of $1.5 billion in this latest quarter. So that's an increase of 12%. Both record sales and net income up from the year prior. And then the fourth quarter outlook also helped to send those shares soaring today. We'll talk more about the fourth quarter in a moment. But this follows, positive results from peers such as Abercrombie and The Gap. We've been reporting on a lot of different retailers who have been reporting strong quarters, which is interesting when you think about people maybe trying to save a little more money. It's not really reflecting that when we talk about consumer spending. When it comes to Urban Outfitters, important to keep in mind, this is also the owner of the store Anthropologie and the brand Free People, which is a pretty popular brand. So women's denim helped at Urban Outfitters when it came to sales. And there's a new brand called Maeve at Anthropologie that also helped with sales. But in an earnings call, the executives have said, although consumers are still waiting longer for holiday deals, they don't seem deterred, at least they didn't in the last quarter, by paying full price for items, which is pretty interesting to hear.
That's interesting. Yeah, the people weren't going in sniffing around for bargains necessarily.
They just seemed okay with paying full price.
Yeah. They have a bit of a cult following, I think. According to Rolling Stone, they're great for baggy jeans, floral dresses for a rooftop party. Yeah. So it's not formal clothing.
It's not workwear. Formal. Yeah, it's not workwear. It's a lot of like what you would call campus wear, right? They're really trying to appeal to kind of the Gen Z base. And if we look at, moving forward, what's really interesting is obviously Black Friday is this week. We've got the holiday season right around the corner. And in that earnings call, the CEO and president of the company, Richard Hayne, he did say they anticipate the holiday season to be highly competitive, what he said. And they have observed a slight shift when it comes to consumer behavior. They believe consumers are waiting a bit longer this year to make their purchases, waiting for promotions, waiting for deals. And the CEO did say Urban Outfitters was able to make a shift, though, with a strong early presence into the holiday season, which helped them keep those sales up.
Yeah, it's fascinating. I guess that's the thing in retail. You want to avoid discounts if you can.
You do, right? But I mean, sometimes you get more people flocking towards your store if you have a lot of discounts, and Black Friday is a really good example of that, right? A lot of stores have to hire seasonal staff to help out with the crowds you get throughout Black Friday.
Yeah, I don't think I'd last in retail at Christmas.
I don't think I would either. I'm not a crowds person.
Yeah. And
can we talk about the Q4 outlook very quickly?
Sorry.
Because that was something that really helped as we see, the shares jumping today for Urban Outfitters. The Q4 outlook was a big part of that. So I'll just go through some of the expectations. Total sales growth in the high single digits for Q4. They expect total revenue to also grow, profit margin growth by 25 to 50 basis points. And that's driven by lower profit margins. That includes growth at both Anthropologie and the brand Free People as well. And then something else that's interesting that's really helping to boost sales is something called Newly. So this is like a retail subscription rental program that Urban Outfitters has. It's been happening since 2019, but they've recently started like an in-store return part to this as well. So basically you can get a subscription through Urban Outfitters and you can rent a certain amount of like dresses or whatever you need, maybe for the holiday season, for like a holiday party, and then you're able to return it afterwards. So that's also helping to drive sales up.
Yeah. What do they say? You should go through your closet. Anything you haven't worn in a year?
They say that. I don't do that. They do say that, though.
Thanks very much, Lindsay. Lindsay Biscaya, our own Lindsay. Okay, coming up, we are going to take a look at some early market movers, including Calian Group. It's a supplier to the Canadian Defence Department. Its stock is higher. Okay, let's check out some stocks on the move right now. First, we'll have a look at the TSX. You can see the TSX pushing higher in early trading, and it's been boosted, of course, as I mentioned before the open, by the bank stocks. That group, the TSX Banks Index, hit a record high yesterday. And ring that bell. It looks like, yep, we're in record territory for the TSX now. We're topping 31,000. I don't think the TSX has ever managed to end above 31K. So Breaking news, we are at a record high for the TSX. Let me just tell you who's helping out in terms of big value traders right now, pushing our market to a new record high. Manulife down slightly. Brookfield Asset Management is up. The Brookfield Group plan a big storage acquisition in Australia. I don't know. If I had an Australian storage unit, I'd check it pretty carefully for spiders before I went in there. Toronto Dominion Bank higher. Royal Bank pushing further into record territory. Shopify up about 1%. That always helps. Let's have a quick look at Calian, though. As I mentioned, it's a provider of consulting and services, among other things, to the Defense Department, the Canadian Defense Department. And revenue was up 12% year over year to just over $200 million in the latest quarter. Their health and learning segments did well, specifically in defense. As far as I remember, they provide some health services to the Canadian military. Anyway, that stock moving up. Let's have a quick look at Celestica, because has it ever been volatile? The stock down a bit right now. It is used as a way to bet on AI, artificial intelligence, by many investors, because it's got such a big franchise in building out this equipment. Coming up, expectations for markets and ideas for your portfolio as we head toward the end of the year. Welcome to the second hour of The Open. I'm Andrew Bell. Here are the big stories we're bringing you from the BNN Bloomberg newsroom. CTV News says the Prime Minister, Mr. Carney, will announce measures today to help Canadian steel producers and providers of softwood lumber. There are multiple reports now that more financial aid will be announced for both industries. This comes as steel, aluminum, and lumber companies continue to deal with high tariffs imposed by U.S. President Donald Trump. Brookfield Asset Management and Singapore's wealth fund GIC have offered to buy an Australian-listed company called National Storage Real Estate Investment Trust. The deal is valued at more than $2.5 billion US. The Australian self-storage provider says it aims to strike a deal by December 7th. National Storage operates more than 270 centres across Australia and New Zealand. Another look at shares in Deere slipping. That's after the tractor maker's profit forecast for the year ahead fell short of expectations. Deere estimates that 2026 sales of its big agricultural segment will be down 15 to 20% in Canada and the US. In August, Deere said tariffs had costed $600 million US. And the TSX hitting a new record high in trading right now amid fresh strength in bank stocks. So we're pushing into new ground. Last time I looked, let's have a look at the American markets. I want to see how close the S&P 500 is to its record level. It was higher in early trading. The American benchmark, as you can see, just under 6,800. Its high point was October 28th at 6,890. So we're still about 100 points down from that. Let's have a look at oil, because it's had a miserable week, partly on the good news that there may be an end to the fighting in Ukraine. U.S. President Donald Trump hailing progress on a pact there, and oil trading near its lowest in a month. And finally, let's have a quick look at gold, because there is an anticipation that the Fed is leaning towards another interest rate cut next month. Usually that'd be good for gold, but bullion has been rallying lately, so it may be priced in. And finally, let's have a look at the Canadian dollar. and it is holding its own today, up a little bit against its U.S. counterpart. Analysts are weighing in with price targets for the S&P 500 for year end. Our guest sees that benchmark hitting 7,000. We're joined by Jay Hatfield, CEO and Portfolio Manager at Infrastructure Capital Advisors. Jay, as always, great to see you. So we're almost at 7,000 right now. You reckon that would put the market at a multiple of about 23 times. Not low, but you say there are reasons to justify it.
Good morning, Andrew. It's great to be back. Well, so what a lot of people forget, they use historical PE multiples, but we had this gigantic cut in the corporate tax rate in 2017, which raised, in our model, raised the theoretical sustainable PE from 18 to 22. So 23 is only a little bit above that level. We think that's justified because the Fed, even though there's a lot of disagreement, is clearly going to cut, at least when we get a new chairman, probably cut in December. That's super bullish. The AI boom is bullish, not just for, obviously, for tech companies, but for some of the real economy, power and real estate. So that should provide extra growth. So we think that a 23 multiple is justified. And we also have a 7,900 target for next year. There is 13% earnings growth expected, a lot of that from tech. So same multiple, though we're not forecasting a big multiple expansion because it is pretty fully valued. And the target should be used both ways. It was a pretty good place to fade the market when we got right around that 7,900 level that you mentioned.
Yeah, so that's interesting. So when a market hits a target, you think people should think, well, do I want to go on owning it?
I'm at 6,900. Yes, of course. And you'll notice when we recommend stocks, we always have targets. So because you can get really burned, as a lot of investors did in the U.S. during this downturn, because they were buying stocks trading at unreasonable multiples of growth rate, like even up to 7 times PEG ratios. And then, of course, if you invest in things without cash flow, you can get really burned. So targets matter, and it's a great way to avoid really big losses, which is the key to long-term success.
You say that the AI is not a bubble, but you are seeing areas of overvaluation, including some crypto treasury companies that hold Bitcoin, for example.
Yeah, so what's very strange is that there was a need for crypto treasury companies before you had ETFs, because we had a big regulatory roadblock in the SEC to get crypto, or particularly Bitcoin ETFs. So they were filling that void. But then once you get them, why do you need it? Why do you need a levered, more risky opportunity to buy Bitcoin that often trades at a big premium? But then when Bitcoin's down, you lose all the premium, so it goes down way more. So it's kind of an anachronistic vehicle that should go away. It might get excluded from the big indexes, and that might precipitate less of it as well.
What about this battle between Google and its Gemini AI model and OpenAI? Is that an important theme for investors?
It absolutely is. It's driving the trading in these stocks, in the big tech stocks, almost every day. And I would point out, not that we're predicting some horrible outcome for OpenAI, but it is a company that's losing a tremendous amount of money. Its valuations in the private market are 25 times sales versus 7 times sales for big tech companies and about 3 times sales for the S&P. So it's a pretty fully valued company with very stiff competition from Gemini, and it's in the retail market, which is much more competitive than the corporate and industrial market. So that's why you've seen weakness in Oracle and Microsoft and huge strength in Google and Broadcom, because Broadcom supplies chips to Google. So it's creating big movements, as it appears, at least for now, that Gemini is gaining, if not has an advantage over OpenAI.
Can we just switch to inflation? You have in the past argued that inflation in the United States is underestimated by the official figures. Update us on that, Jay.
Absolutely. So it's all about shelter. The rest of the world just uses market rates to determine shelter costs. But in the U.S., first of all, we delay it for 6 months, which is just gross incompetence or terrible methodology. So we literally don't update it, only update it every 6 months. And then we use arcane measurements of owner's equivalent rent. It's really meant to slow down inflation because we had really bad inflation in the 70s in housing. But what it does is makes the Fed, because they actually slavishly follow it, about 2 years behind. So we adjust it to do it like you would in Canada or in Europe and just use market rents. And our CPI is 1.3 and our PCE core is 2. So they're just using the wrong data. So we need a reform of the Fed. Hopefully the new Fed chair will come in and produce a new framework so that we don't have this terrible policy that's behind the rest of the world and holding back economic growth.
And you're no fan of Jay Powell. Tell us why.
Well, just for exactly that reason. But there's another element, which is a lot of investors don't recognize this because everybody was trained in Keynesianism, which is, I would argue, is more of a political theology. But inflation comes from the monetary side. It's excessive growth in the money supply. During the pandemic, it grew 60. Nominal GDP 38, and of course inflation is 22. So Milton Friedman was proved 100% correct. But this Fed chair doesn't believe it matters at all, which is just malpractice and led to the transitory theory of inflation, which was 100% wrong. So one of our worst Fed chairs since World War II.
Okay. Are you buying U.S. government bonds these days? Maybe you'll put up the 10-year bond yield. I know it depends on your holding period. Say you had a holding period of 5 years. Would you be buying 10-year treasuries?
We would. I mean, we don't trade a lot of treasuries. We're implicitly buying treasuries because, our largest fund, PFFA, is a preferred stock fund. So it's fixed income. So half the return comes from the price of treasuries. The way to trade U.S. treasuries, at least, if not in most countries, is it trades 100 over the terminal Fed funds rate. So where the market thinks the Fed funds rate is going, it's traded that nearly 100% accurately. And so we are bullish at the Fed will cut rates because inflation, even measured inflation, is going to come down because finally those indices are tracking our index. So we think we'll get to, we'll have a pretty big rally in a 10-year, but not huge, probably down to the 375 level. 275 is our estimate of the terminal Fed funds rate. So a little bit of upside for investment-grade bonds and treasuries. We think more upside for riskier fixed income like high-yield bonds and preferred stock.
And just finally, the U.S. debt. Is there really ever going to be progress on that? The massive overspending and accumulated debt. Is there any hope politically that the parties will get serious about it?
I would say no, but there is the one exception you referenced, is that at least for now, the president in the U.S. can impose tariffs, which is not just unpopular north of the border, but really unpopular with consumers and many, many companies. But he has done that, or the administration has done that. That's $400 billion of revenue. That's a lot. That's almost 1% of GDP, and it's going to reduce in our models our debt to a sustainable level, our deficit rather, to a sustainable level at 4.5%. We're growing nominal GDP at 5%. So that our projections show a gradual decline in debt to GDP. But for those tariffs, though, I would say there's close to 0% chance of any fiscal responsibility because we don't have a balanced budget framework in the U.S. for the federal government. And politicians want to get reelected, spending money and cutting taxes is popular, raising taxes is very unpopular. So you never get any fiscal discipline unless it's imposed by the administration, which really is only tariffs.
You're a guy who likes to go against the grain where appropriate. For decades, we've been told, well, theory of comparative advantage, a multilateral free trading framework globally is great for everyone. Do you think, is there a nuance there? Have we been sold a bill of goods? Should some protectionism be imposed?
Well, I would distinguish between trade wars, which, to be fair, at times the U.S. has been pursuing what looks like a trade war with Canada and definitely with China. So I think what you're referencing is absolutely true with regard to super high tariffs. Having tariffs in the 10 to 20% range is much more like a sales tax and isn't probably enough to really drive comparative advantage and the efficiencies, and can be easily arbitraged away. So we're in favor of modest taxes, really on other things as well, like pollution taxes, instead of just taxing corporate profits and wages, which discourage work and investment. So, but we're not in favor of these huge taxes that have been imposed and are being imposed, as you mentioned. They're really close to uneconomic on some raw materials like steel and lumber.
We'd better go. Jay, thank you very much indeed.
Thanks, Andrew. Thanks for having me on.
Jay Hatfield, thank you. CEO and Portfolio Manager at Infrastructure Capital Advisors. Coming up, more people are turning to the discount online giant Temu and also Shein for savings this holiday season. But it comes amid warnings about the quality and safety of some of the products. More people are turning to the online retail giants Temu and Shein, both affiliated with China, for savings this holiday season. But there are new warnings about the quality and safety of some of those products. CTV's Kelly Gregg has more in this report.
With Black Friday and Christmas, for many, it's the season to spend. But according to the Retail Council of Canada, Quebecers plan to buy 20% less than last year. And that could mean turning to this. Shein and Temu are both Chinese-owned sites where items can sell for next to nothing.
It's ultra fast fashion. When you have the possibility to develop and to sell more than 7,000 product a day, it's huge.
A study done by International Consumer Research and Testing tried out 162 products from both sites, including toys for children under 3 years old, USB chargers, and necklaces. Out of the toys, 30% from Temu had a major defect, and only one was deemed passable. When it came to Shein, 37% had a major issue, and not one of the tested toys passed. Marie-Ève Schaffer from the consumer publication Protégez-vous says during testing, some small pieces broke off and presented a choking hazard. They also found one of the toys could emit a noise of 515 decibels, equal to a jackhammer. Nearly all of the USB chargers from both sites had a problem. One of the major issues there was overheating. And for the necklaces, the vast majority passed, with only one issue from Temu, with Shein being more unreliable. The tests were done in Europe, but many of the safety standards are close to Canada's. Shein responded to CTV saying the products were sold through its website by a third-party vendor. It says it removed the items and commissioned its own testing. As for Temu, it could not meet our deadline. The findings come as more Quebecers turn to these low-cost websites. A recent survey found in the latter part of last year, 1 out of every 5 Quebecers bought something on Temu. Now it's 34%. For Shein, it went from 16 to 25%. People have tight budgets and want to get the most bang for their buck, says Schaffer. But if it poses a risk, is it worth it?
Maybe we have to wait and to have an accident to see something coming from the government. But right now, nothing.
Consumer groups urge shoppers to be careful with their giving so you know what you're really getting. Kelly Gregg, CTV News.
A renowned American beer brewing school is locating to Montreal. We're talking about the Siebel Institute. It cites changes in the U.S. for the move to Canada. CTV's bureau chief, Geneviève Beauchemin, has more in this report.
This nondescript Montreal address, just a few blocks from the original site of Molson, the oldest brewery in North America, is soon to be home to a prestigious beer brewing school. Since 1872, the famed Siebel Institute has taught the fine art and science of brewing to generations in Chicago. But it has announced it will soon be last call in the U.S. Siebel issued a statement pointing to changes under the Trump administration. Recent regulatory changes in the U.S. have made it much more challenging for many of our international students who have become the majority of our student body to attend classes in person. To many in the brewery scene in the U.S., the loss of Siebel, woven into the history of Chicago, is heartbreaking.
But it truly is just a Chicago institution. And, you know, if you talk to brewers of the modern era, not just in Chicago, but across the nation, it really is the place where people go and learn the trade.
So that's where we actually brew the beer here?
Quatre Origines has been brewing craft beer in Quebec since 2018. On tap from Montreal now, says the president, Michael Dornelas, is a university of beer.
Siebel Institute coming to Canada is big news. Essentially, they offer a wide range of education options specifically for this industry.
A prominent addition to Quebec's already vibrant scene as knowledge and workers will spill over.
I really think it's going to focus a lot of attention onto Montreal as a destination for beer, which the U.S. that's where all the focus is for craft beer. Like, we learned from them.
And the move is expected to come into effect as of this January. Geneviève Beauchemin, CTV News, Montreal.
A loss for the United States. Up next, we are going to be updating you on some of today's notable calls, including a price target boost for tech resources. Let's check out some analyst calls today. Our first is on tech resources. We're talking about the NYSE listing. Deutsche Bank raising its price target on tech resources to $46 from $45 and sticking with the buy rating as part of its outlook for the copper sector. Deutsche says severe supply disruptions have pushed copper to near record levels. Of course, tech now trading on the supposition that it will, in fact, be bought by Anglo American. The votes on that set for less than 2 weeks. Our second notable call is on Dick's Sporting Goods. Telsey advisory analyst Joseph Feldman lowered the price target on Dick's Sporting to $245 from $255. That's US. And sticking with an outperform rating on the shares, the firm believes that the company is, quote, uniquely positioned to improve the business and is well positioned given its structural position, the analyst tells investors. And our third notable call is on JM Smucker. That's a defensive stock. We all need jam. Bank of America raising the firm's price target to $120 US from $118 and leaving a neutral rating on the shares. That's after Q2 adjusted EPS came in slightly above the brokerage firm's forecast. The company itself raised its fiscal 27 and fiscal 28 adjusted earnings per share forecasts to $10 and $10.80, respectively, from $9.80 and $10.60. And the company's sales reported yesterday hit $2.3 billion. Coming up, we're going to be taking a look at some of the big winners and losers on the TSX this year. Look for that on our show in the next few weeks. We're going to start off with Aris Mining, which has soared almost 270% on the TSX this year. We'll hear from the CEO. CTV News says the Prime Minister, Mr. Carney, will announce measures today to help Canadian steel producers and companies in the softwood lumber sector. There are multiple reports that more financial aid will be announced for both industries. This comes as steel, aluminum, and lumber producers continue to deal with high tariff rates imposed by US President Donald Trump. The Globe and Mail says the Canadian Securities Exchange is considering buying CBOE Canada and CBOE Australia. The report says the talks are preliminary. There's no guarantee of a deal will emerge, according to the report. CBOE is said to be selling its Canadian segment because it's realigning its portfolio of businesses. But of course, a merger could create a bigger competitor for the Toronto Stock Exchange. Another look at shares in Urban Outfitters climbing in today's trading. That's after the clothing retailer posted record sales and income in its latest quarter. The company says it saw strong results in early holiday events, helped by customers waiting longer for seasonal promotions to begin. Urban Outfitters now expects total revenue to grow in the high single digits for the fourth quarter. And the TSX hitting a new record high in trading today, on course for its first ever close above 31,000. The S&P still down slightly from its October record, but you can see the NASDAQ moving higher as well. It looks as though investors are generally gravitating back to those big U.S. tech stocks. Just checking about the NASDAQ here. It's still down from its record high of just under 24,000 on October 29th. Dell missed on revenue in its third quarter, but a strong forecast driven by AI sales has investors remaining upbeat. We are joined by Bloomberg's breaking news editor, Lara Sandley. Lara, talk to us. Thanks for joining us. Talk to us about Dell, please.
This is, as you mentioned, very much a story about AI and the fact that AI servers are in a lot of demand. In the past quarter, the company booked over $12 billion in AI server orders, and they shipped half of that. And now they have a backlog of over $18 billion, really signaling that there's a lot more to go, a lot more to ship out. So they boosted their shipment projections. But despite that, there's a significant cost to keeping up. There are rivals like Supermicro that are really racing to build these systems, and it's driving expenses up. And the company is trying to minimize the impact and working to make this AI server business more profitable. Another thing that happened in the earnings is that they had a leadership move, officially promoting the interim CFO to CFO. But overall, despite that, investors are optimistic and they like what they saw because this is a sign that AI momentum is really accelerating, and it is only going to continue in the second half of the year.
And what's going on at HP, please?
This is also a story about AI, but a little bit different, about using AI to sort of optimize and increase efficiency. And here they are cutting 4,000 to 6,000 jobs due to AI, saying that these jobs can be replaced by AI. And this comes just 3 years after they actually finished a similar restructuring, cutting a similar amount of jobs. So pretty big job cuts that they're announcing here. And the CEO says the move is very necessary to keep the company competitive in these times with all of this AI. And the cuts are expected to generate $1 billion in annual cost savings, but there will be a little bit of a charge in the meantime. I believe it's $650 million in restructuring charges. But really, in addition to the cost cuts, or in addition to the job cuts, what the investors are really watching is a bigger disappointment. That's the outlook. The outlook was not where it needed to be. They see the year profit below estimates, citing rising costs when it comes to memory chips. The company says it has enough inventory to cushion the hit in the first half, but for the back half of the year, it's adding new suppliers and raising prices where it's needed. So AI is definitely reshaping the company, reshaping the economy, but the question is on how fast these savings can offset rising costs and how the company will be positioned going forward.
Thank you very much. Thank you very much indeed, Lara. Lara Sandley. Okay, we're going to be taking a look at some of the top gainers on the TSX this year in the next few weeks. Aris Mining is well up. The share soaring more than 260% since the start of the year. And the 1 year return, the 12-month return, you can see also a three-bagger for investors. We're joined by Neil Woodyer, the CEO of Aris Mining. Neil, thanks for joining us.
Thank you for inviting me.
Just remind us about Aris Mining. You have two mines in Colombia. You produced more than 200,000 ounces of gold there last year. And your target is to get to 500,000 ounces. Tell us how long that will take.
Okay, we started 4 years ago. We've acquired two mines, and we're now this year producing about 250,000 ounces. We're expanding both mines. We've expanded our Segovia mine, which produces 200,000, the production facility, and over the next year, we'll ramp it up to 300,000. We're also expanding our Marmato mine by building an industrial mine below the small mine that we have, and that will take us to just over 200,000. We expect to have the first gold pour towards the end of next year. So in total, in a year or so's time, we'll be at 500,000 ounces. And we have two additional projects, one in Guyana and one in Colombia, which if we're able to put that into production over the next few years, in fact, gives us a very clear road to 1 million ounces from our own resources.
How many years could that take to get to 1 million ounces a year, roughly?
I think by the time we have Soto Norte permitted, 2.5 years, 2.5 years to build, 5 years order of magnitude.
Now, you got in a tangle with Colombia. You took a dispute to arbitration. That's now settled. What was that all about?
Well, it was started by our predecessors who were complaining to the government they weren't helping them get access to part of their tenement above the current mine at Marmato, the upper mine. Also that they weren't getting the security that they should get from the government at Segovia. So they sued the government 2018 for $350 million. After we took over Gran Colombia a couple of years ago, I came to the view that it's probably not best to be suing a host government. And even if you won, you probably wouldn't get $350 million from the government. You would probably get a lot of negative press. So the best thing for us to do was to negotiate and find a compromise where we could work with the government. So over the last 2 years, we've done that. We now have an agreement with the Ministry of Mines, with the regulatory authority, to help us formalise the area above our present mine and take production into our mine. In addition to that, we have arrangements with the Army and the Navy to improve the security around Segovia. So we achieved what we wanted to achieve without any cash transferring, and also we obtained very, very much goodwill from the government in doing so. This was the first arbitration they've successfully gone into, and I think it's improved our relationship, which will help us in the future.
You mentioned security. What is the challenge there? Is there pharmaceutical activity in the area, for example?
No, it's a relatively benign area. There is some illegal mining on our site and our area, so we have to clean that up. The really bad guys are far away from us, so that's not too bad. So it is really just improving the day-to-day security, because at $4,000 gold, it's very easy for people to decide to go in and pick some themselves.
That's interesting, yeah. I mean, it's not unknown in Mexico for gold production to be stolen at mines. That's interesting, yeah.
Well, in Colombia, I think one of the interesting things is it's a country of huge gold potential. Only 15% of it comes through formalized industrial mines. 85% is small miners. There are 350,000 small miners operating in Colombia. So Colombia is ranked at about the world's 50th producer. But if you included all that, you get to around about number 10. So it is a significant gold producer. It is just very informal, small mines, low-level industrialization, which is our potential.
It's interesting. I remember reading years ago in Colombia, these informal miners, they'll detect some rich gold. They'll just get a backhoe and dig it up.
Yeah, some of them are a bit more sophisticated than that, but the issue is there's no clean processing. When they process, two things happen. They've got to get rid of the tailings and the damage that they do. And the second thing is they only get about 45 to 50% recovery, whereas we get 95% recovery. So if we could work with them, which is what Aris has started to do, it significantly improves the dollars coming out of the gold. So we have more to share with them, and we formed these partnerships with them, which have given us tremendous support in the community and really enhance our license, and also fall in line with the current political thinking of the government, which is the formalization of miners. And that's exactly what we've been doing, using our processing, working in true partnership with them.
Yeah, I guess I'm not sure if this happens in Colombia, but they use the informal miners. They use terrible things to refine the gold, don't they? Mercury and arsenic, and it's a health hazard.
It's not only a health hazard; it reduces their lives too. So yes, we can clean that. We've cleaned a lot of that up, and that's why we're attractive. We can take these illegal miners who are part of the black economy to be real businessmen operating with us, paying their taxes, getting their social services, and being totally legitimate, and not under any pressures that from anybody who would like to take advantage of them.
Just talk to us about this Soto Norte asset. You just took 100% control of it. What is that? How big could it be?
Soto Norte is a huge gold deposit. It was originally built up by Ike Batista. Mubadala went in and lent him $1.2 billion. They spent a lot of money on it. They subsequently owned it. They had designed an absolutely huge mine, which failed to get environmental approval. So a couple of years ago, we persuaded them to sell us 20% and let us manage it. And as a result of that, we were able to determine that the mine they were building was totally inappropriate on they're trying to build. It was just too large. It had too many risks. It was too strong in front of the environment, too strong in front of the community, and it had a lot of community objections. So we've reshaped it, reformalized it. We're talking of a mine about half the size, much smaller environmental footprint. The tailings facility is about 40% of the original, relocated. They were going to build a 7.5-kilometer tunnel between two mountains. And the idea of a tunnel boring machine on top of the Andes is kind of risky. So we've resized it, re-risked it, got a lot of community support because we've taken people from the area to our mine at Segovia, where we're working with the small miners, and said we can do this the same thing. In fact, we've designed the mine and we intend to build something 120% of the capacity that we need. So we'll have 20% capacity available for partner small miners that we can create and work with in the community. So a very much reshaped mine. And as a result of that, we were able to negotiate some time ago that we got up to 50%. And I was able last week to negotiate the additional 49%, which now gives us 100% of the mine.
You've been around for a while, haven't you, Neil? You were founder and CEO of Lee Gold Mining and Endeavour Mining. Endeavour Mining, huge now in West Africa. After Aris Mining, well, what are your plans? If you sell Aris Mining, I don't know if you will, but will that be it, or will you get into another gold startup?
Well, I must be honest, I'm 82, so this is probably my last go, so I'm really enjoying it. Now, I think when I think back to how we dealt with the two companies, we built Endeavour up over a 5 or 6 year period, and I think it was about 500,000 ounces when we left. It's now 1.1, so they've done a fantastic job. That's what I'd like to see at Aris. Leah Gold, I think with reflection, I put it into Equinox too soon. I should have taken it to the next step. Here we now have 250,000, expanding, fully financed to 500,000, and we have very concrete plans from our own assets to take us up to the million. That is where we determined to go, and hope we're allowed to go there as a management team. At that time, it's probably time for me to walk away and perhaps retire. So I'd like to see it continue on life with a change of management style.
Did you say you're 82, Neil?
I am indeed.
Good man. Thank you very much indeed. Neil Wood, you're CEO of Aris Mining. Coming up, we're going to zero in on 3 hot picks in U.S. healthcare. Time for hot picks. Our guest says that over the past decade, he's had very few holdings in healthcare. A lot of the names trading at elevated prices. But he says more recently, that sector has underperformed the S&P, creating lots of opportunities. We're joined now by Alex Fitch, partner, portfolio manager and director of U.S. research at Harris Associates. Thanks very much indeed for joining us. Let's get into your ideas, if that's okay. First off, Centene, it's CNC in New York. What do they do? What attracts you to this stock? Oh, do we have Alex? Okay. Okay. Go ahead, Alex. Yeah, thanks for joining us. Sorry about the glitch there. Tell us, what does Centene do and what attracts you to the stock?
Yeah, well, just to start off really quickly, Harris Oakmark, we're long-term value investors. As I heard you mention, we haven't had many holdings in healthcare for a long period of time here. And the reason was that the valuations were reasonably high and we found better opportunities elsewhere. That's been changing in recent years, especially in the highly out of favor parts of the healthcare market, like managed care in particular. Managed care has been very challenged for the last 2 years here. Really been hammered by two things. One, we've had policy shifts that have made for an adverse mix impact. The second is that we've seen this very sharp acceleration in the cost trend in healthcare. And the combination means that in a lot of cases today, premiums just aren't adequate to reimburse the companies for the costs that they're taking on. That is especially true in Medicaid and in the exchange business. And Centene is really in the center of that storm. This is a company that's one of the largest players in Medicaid, one of the largest players in exchanges. And they somewhat predictably have had really sizable earnings headwinds in recent years. You've seen their EPS fall from something like $7 a share in 2023 and 2024 down to around $2 per share this year, and the stock has followed suit. The beautiful thing to us about managed care is that this is short cycle insurance. This is not property and casualty insurance where if you write a bad policy, you're going to be on the hook for 2 decades. This is business that reprices annually. And historically speaking, if I can slightly alter the old phrase, the thing that changes, the thing that fixes low margins is low margins. That's what we saw in 2015 when the exchanges were relatively new. We had too much capacity come in, but just 2 years later, we were back at peak margin levels. We saw that in 2020 as well. Today, I think we have all the precursors of that market recovery coming into place. All of the companies in the public market that operate in the exchange business are losing money in that business line today. CVS is saying they're going to exit the market. If you look at Medicaid, the public filings show that everyone across the industry on average is losing money and states are getting more generous on updates. Our opportunity is that investors are hyper-focused on, is the recovery going to be 3 quarters from now or 6 quarters from now? We don't really care when it happens as long as we're being adequately compensated to wait. This is a $39 stock where in a few years we can see them back at $7 of earnings power. 5.5 times earnings feels like that compensation.
We're tight for time. Molina Healthcare, what draws you to this one?
Molina, similar story to Centene, in the heart of the mess today with Medicaid and exchange exposure, but 2 wrinkles. First, I would say that it's the best managed company in our view in the industry. And second, it's the most efficient operator. And so in a world where the average Medicaid company is losing as a negative 1% profit margin, Molina is still making a positive 2% profit margin. And if we get back to the industry earning its cost of capital, Molina earnings need to more than double. The other thing that those 2 wrinkles provide to us is margin of safety. Their efficiency means this company is still earning $13 a share this year. This is a $145 stock. So we're paying 11 times trough earnings today. Like Centene, we think normal mid-cycle earnings are dramatically higher. And once again, when you adjust for that market recovery that we believe is likely, we're paying a mid-single-digit multiple of EPS.
Okay, so another health insurer there or managed care. And then finally, a very different company. I always forget how to pronounce it. Is it IQVIA? They're a health data provider.
IQVIA, yep.
IQVIA, thanks.
A little bit of a different animal than the health insurers. This is a clinical research organization. And so what they do is they do clinical trials on behalf of pharmaceutical companies.
Okay.
The easy way to think about the business model is that this is just a growing royalty on pharmaceutical R&D spending. And that used to be a prized model. They grew at the high single digits. They earned high returns on capital. Over the last 3 years, though, the stocks really meaningfully underperformed the S&P 500. And the reason, the culprit, is really growth. COVID, as we all know, it drove a boom in R&D spending. A lot of work was pulled forward. IQVIA and its peers had their revenues overly inflated, and we've been through 3 years of really weak or even negative organic growth for the group. Our view is firmly that this has been cyclical. and not secular. And we're starting to see the tide turn here. Biopharmas are getting back to spending, and IQVIA growth is accelerating. In a lot of ways, it is what we think managed care could be 12 to 18 months from now, where investors are now becoming convinced that the bottom is in. They're becoming convinced we're set to accelerate from here, and stocks like IQVIA are up 50% off their lows. We still think we're early stages in this recovery. There's a lot of growth in pharmaceutical R&D still ahead of us. When we get back to high single-digit growth for the clinical research organizations, we suspect they won't trade at the 20 to 30% discount to where they used to anymore.
Alex, thanks very much. Really appreciate it.
Thank you for having me.
Alex Fitch, partner, portfolio manager, and director of U.S. research at Harris Associates. Okay, we've got to take a break. We'll have one last check on the markets with Toronto in record territory. Let's check in on the markets in the couple of minutes left for us. The TSX trading in record territory right now. Year to date, let's have a look at the TSX year to date, because our market, of course, has gained big time from the rally in mining stocks, especially gold stocks. So we're above 31,000 on course for the first above 31K close forever for our benchmark index. The materials index has been the engine, though, for the TSX this year, soaring, believe it or not, 87%, driven by golds. Discovery Silver is up more than ninefold. Aris Mining, we just talked to the CEO, is up more than, or about fourfold, almost fourfold. It's hard to find any material stocks that have lost. Poor West Fraser Timber, the lumber company, down 31%. Lumber giant. Interesting, actually, even though Teck Resources is being taken over, that stock's up only about 4% this year. So the shareholders in Teck didn't get a monster premium. And we know the federal government has to do a bit more dithering before it decides whether or not to approve this deal. One of the weakest groups, in fact, the weakest group in Toronto so far this year has been healthcare. And it has suffered. There it is, year to date, down about 4%. And I'll try and work out what stocks have been weak there. It's interesting that, we know that the cannabis companies still aren't delivering the massive profits that investors had hoped for. So in the healthcare index, we've got Curaleaf, Chartwell. Oh, here's the reason. Bausch Health is down something like 23% this year. That's why the healthcare index has done so badly. But these senior housing stocks, Chartwell is up 35%, and Sienna Senior Living has soared 34% this year. Let's have a look at the old TSX over the past 20 years. And for a 2-decade look, going right back to the early part of this century. And there you have it, a 20-year look. I think that's a 20-year look at the TSX. You can see up 187%, excluding dividends. Oh, we're out of time. Thanks very much for watching The Open. Morning Markets is coming your way.